Hello everyone, friends. Welcome to this is already our third lesson. Today's lesson will be considered as the second part of the first lesson, because we will continue to develop the topic of this strategy, which we used in the context of Dow Jones and Fibonacci. Take a look. Remember, in the previous lesson we said that an asset should have at least, or better yet, 3 consecutive bullish candles, where each new candle sets higher lows and higher highs than the previous one. I've noticed, by the way, that with 4 candles this strategy actually works even better than with 3 candles. For this example, I'll use the 15-minute indicator, but you can run your own tests on a different time frame. And in this case, I'm using gold as the main asset to work with. Okay. For example, we have an upward impulse. Let's take this impulse right here. See right here. When we have 3 bullish candle shears, the first, second, third, and fourth, here are those 3 candles. That's when the impulse starts. So what do? We know that any asset after an impulse goes through a correction phase. And what's important for us to know, we need to carefully add the RSI indicator to this particular strategy and set its length to 4 within the settings. Go into the settings and make sure it's correctly set to 4. And let's also set it to 4 here, ensuring consistency. Therefore, what do we need to know? If at the moment when we want to go long, we also place a horizontal line right in the middle at the 50 level, so we can see it clearly. So if we have these 3 candles formed, I'll put it on slow motion for you. For example, here we have 1, 2, 3. That's it. As soon as these 3 candles have formed, what do? We draw the Fibonacci, and at each level such as 0.38, 0.5 and 0.61 we place limit buy orders, that is orders to purchase. Why? Because when the asset corrects, it will most likely trigger this order and make a pullback from it. Understanding this mechanism, which happens quite often, we place orders specifically at these levels, 0.38. But we don't know if this movement ended here or where exactly it ended. So what do? We leave it as is. Before placing orders, we need to clearly understand when the orders. Let me start over. When we have the orders, we'll be able to place them, and we can only place them when a new candle appears. And this new candle will have a high lower than the previous high. In other words, it will close with its high below this high in this case. I'll slow it down, that is, make it go slower. Okay, you see this candle has closed. Accordingly, if it closed below the 0.3 level, we don't place an order at 0.3. Instead, we immediately take the 0.5 and 0.6 levels. And at these levels you can place the order a bit higher. It doesn't have to be exactly at the level, just a little bit above it. At these levels we set our positions. There's a nuance here. If our RSI is above the 50 level, I, for example, often use 41 because I know that according to Fibonacci, a retracement to the 0.6 level is nothing other than a return to the 40 level on the RSI. So if you are above the 40 level, what I do here is place limit buy orders. That is, accordingly, here I place a buy order and set the take profit at the upper boundary of the Fibonacci. So in this case it could be 0.05%. If I place it here, it could be around the 0.04 level, depending on the movement. It's preferable to work with impulses that have at least 0.5 in their movement. Well, 0.46 is the minimum. So right now I'm talking about gold, because it could be different for other assets. You need to study the asset. That's why, remember, when we studied the asset together in the first lesson, I told you to do the calculation. So we know that after every impulse there is a correction, and after each correction we get these kinds of impulsive moves according to Dow Jones theory, and this is where we exit. In other words, there's no need to be greedy. Now, how do we allocate capital? If I enter, for example, at the 0.38 level, right at the very top, I use the minimum lot size. So risk management here, I won't discuss it with you right now because it all depends risk management. I won't discuss it here because the lot size depends on your capital. Accordingly, for example, in my case, if my capital is $10,000, then for these positions, I can start, for example, at the 0.38 level by setting 0.05, if we're talking about gold, and take from this movement approximately within a percentage range. Yes, right here it's about 0.05. 0.05 is about $2, roughly $2 of movement, not take profit, but specifically this movement. That is $2, somewhere between $1.50 to $2. If I enter at the 0.6 level, I can, for example, if I enter at 0.3, 0.05, at the Fibonacci level 0.5, I can also enter with 0.05. And at the 0.61 level on the Fibonacci, yes, let me draw it again so we understand clearly. Here I enter with a doubled volume of 0.1. Now, in the first and second cases, I immediately set a take profit. Yes, for example, like this. And this is also about 0.5, like this. But for the 0.6 level, I usually leave it a bit higher. That is, I hold it up to the 0.5 level, about 0.1. Accordingly, if the market moves like this, it picks up for me once at 0.5, twice at 0.05 lots, then 0.1. The next question is where to set the take profit. I can set a single take profit at the 0.38 level. And at the moment it reaches the 0.38 level, I close this position at break-even. I close this position with a small profit, and I close this position with a larger profit. Why? Because I caught a big move. 0.1 lot on a 0.1% move is about $30 profit. If we're talking about gold, $30. There are a lot of such situations within a day. Now I'll show you some other examples. But you can use a filter, some people use it, some don't. For example, what does an additional filter mean? It's the RSI. If the RSI during a long position is above the level of, say, 41 or 42, so 41.2 and above, then I consider taking a position here. If the RSI is below these levels, that is below 42, so below 42, then I don't consider opening long positions. It doesn't matter. This is an additional filter. But again, you need to do your own market analysis. Look at how the market reacts, how it reacted in the past. In other words, you need to create this strategy, do a backtest, and see how it performed. We'll take a look at this together right now. Now, the next point is the stop loss. Stop loss. Look, according to Dow Jones theory, there's a rule. When the market makes an impulse, it then makes a correction. That is, a correction down to the 0.61 level is considered a normal correction. If the price settles below the 0.61 level, then in fact we have a trend reversal and that previous trend no longer exists and a new trend is formed. Now everyone uses stop losses in their own way. Again, it all depends on the situation. In my opinion, for example, we use either the 0.60 level or the 0.78 level. I set the stop loss at this level. So in this case, yes, the principle here is 1-to-1. But the thing is, we work with how can I explain this properly? We are in a trend. In this situation, the entry is made in the direction of the trend, and in 90% of cases, the impulse is more likely to continue moving upward. But we don't need it to go who knows where. Our goal is to take just these micro movements from the market. And now I will show you how you can easily capture these movements from the 0.61 level to the 0.38 level. In the worst case, you set your stop loss either at the 0.78 level or at the 1.0 level. You'll have about one stop loss for every 10 wins. In other words, your statistics show that you have about 10 times more wins than stop losses. Okay? So if you hit 100, don't worry. Believe me, it's not a problem. You will just work it off over the next few days, sticking to the same logic. You see, for example, I'm not using the Martingale principle here, but you can also apply the Martingale principle in this situation, which works as follows. When you hit a stop loss once, for example, you entered with 0.05 the first time, it's very unlikely that you'll hit a stop loss on all three positions. For example, the 0.3805 level, 0.05 lots, just as an example, and the 0.6100 level, 0.1 lots. We take a little profit at each level, but it's possible that this particular position could get closed by a stop loss. These 98% of trades almost always close in profit, simply because that's how the market works, that's how it operates, since we only need to take a small amount. And even if you hit a stop loss, it's not a big deal. Now, for the very next trading positions that you decide to open, you will simply open either 0.01 and 0.02 lots until you have completely and fully made up for the initial loss that was incurred. At the moment you've recovered, let's say you lost $50 on the first position minus 50. As soon as these trading positions have successfully brought you a significant $50 in profit, clear and substantial $50 in profit, you should then promptly return to the initial starting lot size of precisely 0.05. To better understand how this works, take a demo account and test it out on the demo account. For this, we use our trading robot, which in principle handles this perfectly, and with proper use, you can make about 3 to 4% per month with this simple strategy. Of course, that's if you work, monitor the cycles, and stay here at these levels. Now, let's see what happens next. Let's take this example. You see, it reached the 0.6 level. By the way, here's a little life hack. Place your orders just a bit above the 0.6 level. Just a little, not much. There you go. Now, let's look at other examples where we had a similar situation. For instance, if we needed to open long positions, we're looking for at least 3 distinct candles. Specifically, we need to identify a minimum of 3 individual candle formations. Let's take a look. Here, look, 1, 2, 3, 4. Yes, you see? Here they are 1, 2, 3, 4. Here's the impulse. Let's go back here. I'll place it here. Here's the downward impulse. So what do we have? We have 1, 2, 3, 4 candles. We wait for this candle. And here in this area, we set the 0.5 level. Here, we will be exiting our position at the 0.38 Fibonacci retracement level. And if it had touched our 0.61, we would have exited at that level. If your take profit is triggered right away, there's no need to keep the position open. For example, we set it here. Yes, it made a pullback here and closed all our positions. That's it. Wait for the next pattern to form. So entering at this point further on, it doesn't matter, you just don't need to. That's it, it's played out. Same thing here. Take a good long look at this. Here it is. Clearly visible. See right here, exactly where I'm pointing. It hit the take profit here and immediately too. There you go, and it worked out. Here, the situation is always ambiguous. So when the first one has played out, to stay conservative in the market, I recommend waiting for a new cycle. It's not always profitable to keep positions open. See, in this case, if you had opened here and here, you would most likely have been stopped out here. Yes, the position did move in your favor afterwards. That's not up for discussion. But in such situations, by the way, if we look at this particular candle where we had growth, I want to check it on a shorter time frame because this happens very often. Let me show you now. See, here again, when you reach the take profit, if you entered again, most likely you would have entered here again and this position would have closed. But if you had set a stop loss here for this position and for this one, there's a high probability you would have been stopped out. If you had set it here, it just so happened to catch it, well, in short, a bit higher, yes. Right here then, this 0.61 position could have closed in profit. And even then, that's not guaranteed. It depends on how you would have set it. I always advise not to be greedy and to take small profits from the market. Therefore, when you reach the take profit with the first position right away, of course it's better not to re-enter here. Because there's also such a thing as the market, which after a strong downward move, yes, makes a quick upward impulse, bounces off it, and then the trend can reverse. Just like here, yes. Stories like this are not very good. So if the price shoots up in 1 or 2 candles and grabs your positions, there's a high chance it will pull back. But if it does this kind of move, then know that there's about an 80% chance it will go up again. And it's better to exit the position, leave it, and then wait for the right moment to enter again. Okay? Alright, let's keep going. Let's analyze another example. Here as well. Here it is. Here's the impulse. If you had entered here, you would have exited. Let's look at the 15-minute time frame. Here's the 15-minute time frame. It's about here. Yes, right here. You see, we need an impulse on the 15-minute chart. Here's the situation unfolding. What's happening is the market is moving. We wait for this candle to close, and wherever it closes, we set our positions either here or at this level. If the market has already moved down and hit our profit, there is no need to re-enter here. That's it, it's done its job. We move on to the next trade. In other words, we shouldn't be chasing the market. We just take what is given to us. Of course, the algorithm, the bot, does all this for you, and it becomes much, much easier. Here's the next example. Here it is, the impulse. You see, in this case, it didn't reach, here's the downward impulse, it didn't reach the 0.38 level. That's why I always say set the 0.38 level a little bit lower, because as a rule, the price may not always reach it exactly. And in fact, here we had a close, right? Meaning we locked in a profit. Then you see it moves like this and then turns back in this direction again. In such a case, we don't need to re-enter. We only enter when the first impulse happens. That's it, we don't consider these positions any further. Here it is again, another impulse. Look, here's the downward movement. Impulse. We wait for the candle to close right here. And in fact, we open a position at this level. We open a position here and it closes for us. So it all depends on your take profit. I always recommend you use a small take profit, literally 0.5, maximum 0.1. You make your $20 or $30 and exit the market. Here's a different situation. The same thing. Here it is. You see the impulse, here it goes down. So you would have had a position open here. Here it opened. You would have had one position open here and another one here. This one would have closed immediately. If it doesn't make an impulse like this, you can leave the position pending here. It's very important that it turns back around. If it doesn't turn around and keeps falling, that's okay, no problem, you can re-enter. Over time, as you analyze all this, you'll understand how the market behaves. That's it. Here, accordingly, if you had opened and then closed this position here, you would have locked it in, and this position is 0.05. If you had set your stop loss at the 0.7 level, I personally always set it at the start of the impulse right here. I've noticed that very often it can drop down to the 0.7 level and then bounce off it. So statistically, that's more profitable. And in this way, you can work on absolutely all possible time frames. So the principle for the 30-minute chart is exactly the same. You see, for example, here's the upward movement, here's the correction phase, and here's the upward impulse. Right here, it would have immediately hit the 0.03 level, then the 0.5 level. You see, from this level, we had a bounce. You see the 0.5 level it closed. And it closed really well, as you can see. And the 0.6 level as well here, it reached this point, and here it already gave you 0.1. That's it, the strategy worked out. This position got stuck for you. As I've told you, you see, very often it reaches the 0.7 level and then works out. At some point, if the profit from 0.6 reaches the 0.5 level and you make money at the 0.5 level, you can simply close this position even with a small loss, because the profit from this one and this one will far exceed this minimum. So you can make it even more conservative if you distribute the lots. So you can set the first one even at 0.02, 0.02, set the second one at 0.04 or 0.05, and at the 0.6 level set it at 0.1. This way, you won't even need to wait for this position to close. You just catch the impulse, make a profit exit, catch the impulse, make a profit exit. It's the same thing here. Notice we have 3 candles on the 30-minute time frame. I think you've grasped the essence of all this. Look, here's the impulse, bam, it goes right into this circle. That's it. You should have exited here already. So I wouldn't re-enter here anymore. So I would have entered, placed my order here and here, accordingly a bit lower, and here as well. When this happened, we closed, right? Took this profit, took this one too. That's it. We don't reopen anymore, we wait for another setup. And so on. Friends, I hope this video was useful to you. In order to use, for example, the algorithm, the trading algorithm, to test how it works, you can request it from us, and we will give you 30 days absolutely free so you can test this algorithm. Let me remind you that under no circumstances should you think that the algorithm will solve all your problems. No, that's not the case. Of course, you need to be reasonable and understand that you have to skillfully combine both the algorithm and manual trading. The algorithm helps you in those moments when you're not at the computer or it's inconvenient and so on. With the right interaction between you and the algorithm, for example, the algorithm does automatically place all the positions. But if you feel that the market, for example, isn't behaving the way you'd like, you can simply choose not to place positions according to the algorithm and remain more conservative. Now, here's another life hack. This other life hack is about the trend. What trend do you have here? Yes, on the 4-hour chart, it's a downtrend. Accordingly, as long as this entire trend is downward, you work in the direction of the trend. When the trend is broken, you work in the opposite direction. You should work in the direction of the main trend on the 4-hour chart. Yes, if you are trading, for example, on the 15-minute or 30-minute chart, if you want to open positions on the daily chart, for example, on the daily, you also need to identify the trend and trade in the direction of the trend. The same applies to the daily chart. Note that this algorithm is universal. It's just that with the daily chart, you might have to wait longer to close your position. See, it returned to the 0.03, 0.05 level, then to the 0.06 level, and it came back. That's how you took your positions. So there's no need to invent something new, because pretty much everything has already been invented. Friends, I hope this video was helpful for you. I'll see you in the next lessons. Please write in the comments if you liked it and see value in this. I would be absolutely delighted if you leave us a comment and subscribe. Peace to everyone. Bye.